Welcome, everybody, to another episode of the Good Deeds Note Investing podcast. I'm your co-host, Chris Seveney, along with Jamie Bateman. And today we have a special can't speak, special guest. We have Carson Faris, who is the founder and CEO of Phoenix Investment Funds. Phoenix is a firm that specializes in the acquisition and repossession of debt secured by commercial real estate. So in the past, we've been wanting to have people come on to talk about that commercial space, and Carson's been in the space for 20 plus years, and Phoenix has been around for 6 years. So Carson, how are you today?
Doing fantastic, thank you. How you doing?
Good, good. Before the show, we were just talking about a little bit about how our day was going, and I was talking about a crazy foreclosure sale that we had today and stuff, which kind of shows about procrastination stuff, but we don't really need to dive into that. I'll dive into another episode from that perspective. But, Carson, why don't you, I did a brief intro, but why don't you tell us a little bit more about yourself and what Phoenix does?
Sure. Well, Chris, let me ask a quick question.
Yeah.
How far back do you want me to go? Just kind of a little bit?
Why don't you start with how you started Phoenix, what got you, interested in, the goals from Phoenix, and really kind of what your focus is, kind of fast forward from how you started to kind of where you're at right now and kind of where you think you're going to be in the next 12 months. Because I know right then and there, that's going to take up this whole entire show, because I've already got about 10 questions backlogged in my head. So why don't we kind of go from there and play by ear?
We'll cut the beginning off and just say, after a lot of years of working in the commercial real estate space as a developer, I was a retail developer. And I had the national development manager for a larger retail firm. And in general, I think we were operating in about 13 different states, and we did a lot of shopping centers, and on average, you'd be rotating about 4 million square feet, which equates to hundreds and potentially thousands of tenants, small shop tenants to, large Target styles tenants. And, our goal in that company was to purchase properties that we knew we could turn around and have a lot of tenant relationships that we could put in there and help them roll out. And it was a really good journey. I started there in 2006, and we were really on a big growth path at that point. The company continued to grow and double, and I got to learn and have a lot of roles in that firm. And probably around 2009, when the whole world had a conundrum, we had a pretty large portfolio. We were knee deep in about 4 projects that were in the $100 to $300 million range each, and heavy in debt. As part of those, and when the world shut down, the bank started acting funny, and so I had a great experience of learning banking internally on the borrower side. But our relationships with a lot of those lenders during that time, we got our books cleaned or worked through. And then the relationships built, we found ourselves getting a lot of calls, or at least I would get calls from the people I'd talk to, and like, hey, what do you think about this deal? What do you think about these guys? So all of a sudden it turned into me learning how the bank was looking at these deals and what they needed and what they were trying to accomplish. And I just found that interesting. I left that firm that I was working with and started Western Bay Group in about 2013, I think. And Western Bay Group was an independent development company outside of my old firm, and did some deals there. But all of a sudden, I found my eyes wandering notes again. I had a friend that all he did was invest in notes on a kind of smaller scale, very complicated, smaller transactions. And I, was a partner there. But as I would lean into the projects and really analyze the commercial real estate aspect and what it could be and where it could go and how you build it, I discovered that we're able to expedite the timing associated with his deals, and also improve the return substantially by shoring up the business plan as it relates to the commercial side and knowing what to do with it and how to do it cheaply and efficiently. And as everyone in notes knows, time is the number 1 or 2 factor.
Velocity of money.
Yeah. Get yourself a good basis and make sure you understand the timelines. And so after we were doing 3 or 4 deals with that company on the side, I was asked to come in as owner, had 50% owner, and combine some of my skill sets with that note platform. That started going really fast. I guess I would say. It grew quite quickly. Some of our capital relationships were blended in from my old world, and I was able to translate, the end game of a retail property through the note process, and really educated myself in the details. Started from the bottom again and went all the way to the top to get a horizon picture of what the scenarios would be in the events that you could get hurt, which is also a number one thing to realize. Don't lose money.
Yep.
And that takes a lot of precautions and understandings, and building yourself a good team, hopefully a good outsourced team. Bringing in all the labor when you don't know necessarily when notes will come isn't always the best move. Just free tip. But yeah, we did that. Phoenix did about 40 transactions at a time. We're located in Newport Beach, California. That was rotating through the years until the distress started to really wind down, and the deals were stretching, and the pricing got too high. We had multiple funds open at that time. We had a blind fund model. And in the blind fund model, it's a rare one to be able to get to accomplish, I think, because you write a general prospectus and aim at what you're going for, and the partners fund blind, and you have total election and choice on that capital. But you are paying for the use of their capital from the time they sign on. So you have a cash drag issue, or another way put is you have to transact quickly enough to make sure that preferred return an investor gets does not eat up your overall return for all the work that you've done. And there's a lot of learning lessons in that, and how to stage that and set that up. But we did about $200 million in transactions over the last 4 or 5 years. Most of that in those first 3. The rest of it was fixing the things and finishing them all out and selling them off. As I sit here today, I've wound down pretty much that entire portfolio. Few assets are just kept in company, but for the most part, they've all transacted, moved out, sold, refied, whatever they needed to do. And I went into the environmental space for a while. It's an expertise that we have, and could get into that for a while, but it's probably a different podcast. But now it's back. So defaults are up. I'm tracking the forbearance and defaults by state right now. They're rising long term. 90 plus days are really increasing, and it's a little bit more difficult in the space that I play on larger transactions. But where people are really getting hit right now might be valuable to your listeners, and that is in the smaller community bank world and smaller regional bank world. They don't have a special asset department, which is the department that works on this stuff normally. They generally don't have the sophistication to deal with what goes into the commercial process. And they've never even sold a note before a lot of the times. So this is an interesting time for people looking for a smaller size deal. And in commercial, that can mean, $300,000 to $2 million or something like that in terms of a note purchase, depending on where you live, of course. But there's going to be a lot of that coming up with not a lot of resource. I'm a little bit more focused on the larger transactions, and we try and stay under the big institutions. So, we're really aimed in 2021 for that $5 to $25 million mark, and we'll do smaller ones if we need to. But the volume of deals when they're smaller can really take up all of your capacity. So at this stage, with where the market is, I'm a little bit more focused on waiting for opportunities that are genuinely worth our time, and then executing on those business plans very efficiently. And my experience has shown me doing less well provides a much better return from all than doing a lot of deals pretty well.
Quick question, is your focus on, you mentioned distress coming to pipe, is your focus going to be on one asset class, whether it's office, retail? I know you mentioned you got the strong retail background. I know office right now is struggling. A lot of retail, of course, is struggling, especially food service, and, multifamily in some locations, I think is struggling as well, or is going to struggle. Is there a specific asset class that you're looking to target, or is it kind of more opportunity based on location and just deal and what the metrics and numbers fall into?
I would say it's a little bit of a mesh. There are certain things that we look to avoid right now, and that changes as the market changes. So, for example, don't really care what kind of deal it is. I'm not doing business in New York, Chicago, or New Jersey. Right now,
Who
we've done a
does,
lot of business there, but the legal system there is frozen. So, side note, I have a deal where the person's not paid their mortgage in 11 years, and I've spent 400,000 plus just in legal in the last few years. And then right before we were finally able to get them out, 2 days actually,
bankruptcy?
then the COVID restriction came on evictions and I had to start everything all over again. So there are certain places where we have found it so inefficient to work and be able to reliably get information on timing that we just don't. But to answer your direct question, we are focused in 3 main areas right now, which is going to be industrial. It's a hot market, but really that's where you're going to find your owner users. And that's a really great category if you can find them. It's good. You can help people out. You can work with them. They usually have a story. They know they're building their business. There's a lot of options with those folks. Side note, be very aware if it's going to be an SBA loan, that gets much more complicated. We can get into that if you want to. But overall, those are good kind of interesting places to play. Retail, it's going to be a
shit show
cluster. We have a lot of expertise in it, but that is a place we're going to look and be very careful, but there will be a lot of stuff coming out in there. And third one's multifamily. That's actually going to be pretty tough to find. You'll find some small stuff. I see it all the time, but it's really the people who believe that they're no longer supposed to be paying rent, and what they do and what your legal rights are to remedy that. And do you have the capacity for the holding cost on that? And, overall in the marketplace right now, I'll look at stuff, no matter what it is, because it's a relationship business, as I'm sure yours is. But, if a lender has some issue on a property and they need to get it off so that they look great in committee, or it's just really important to their bank, if we have a relationship with them, we'll look at it and we'll see if we can solve it with them and for them. We try and do that. That's where our business is aimed. It's not even so much on the assets. We know what we can take down without looking at them and what we really want, but really it's a relationship-based business where it takes a long time to build and establish the relationships with special servicers or the lenders or the attorneys or whoever it is that is someone's main focus of deal source, and help them in their job and help them to succeed, because they are going to have a heck of a job in front of them over the next 2 years.
So Carson, I was just curious if you could try to highlight some of the differences between the space that you play in and, more the residential space, depending on your experience there. But obviously it might be a two to three more zeros in the transaction. But how might the timeline or, the moving, the pieces that are moving compared to your typical single family distressed note that someone's trying to turn around and resell or exit through the property? What are some of the key differences there?
I think one of the first things for people to get used to is the laws. So the Homeowner Protection Acts and such related to residentials are not in place for commercial. But on the other side of that fence, commercial people like to say it's the big boys game, and they don't mean that in a derogatory sense. What they mean is you have to watch absolutely everything, because the rules are very, pretend like it's an entity in Delaware. What it says is what it is. And you really have to protect yourself much more, because in the residential side, there are so many forms and natural protections in what has to go for a consumer and the lender has to quantify and live with by the time they've originated that note, that you guys are much, not you guys, residential investors are generally much safer in what they're buying is going to be a real first trust deed, and there's not a lot of hair on it. It's a home. There's a lot fewer parties involved. On commercial, that document can basically say anything, and if you don't know what you're doing, you can give away a lot of rights, or they're not going to stipulate to a lot of the conditions that you're used to automatically in residential. So you could find out the next day that they don't have the paper note, and the courts aren't going to allow that mortgage to be live unless you can show up with a paper note, and the bank's like, sorry, you signed it. Commercial big boy rule. I've seen almost all of it in one way or another. So you got to watch yourself a lot more. Another thing to keep in mind is there are a lot fewer commercial properties than there are residential properties. So the volume, the size, the skills that it takes to unload one, in this market especially, if you are in a commercial space, you need to know that there's a tenant or someone that can use it. And with what's going on in the current business environment, that can be a little tricky, and the depth of knowledge to really feel confident in that and know what the pricing is pretty deep. The two main sources for that in commercial are LoopNet and CoStar. LoopNet is a little bit more free. CoStar is quite expensive.
Yeah.
But it houses a lot of data, and now LoopNet is owned by CoStar. So the mergers world. So anyway, that's one thing to take in mind. And then borrowers are a lot more sophisticated in general in commercial. So they're going to do strategic bankruptcies on the last day. They're going to file lawsuits that are somewhat frivolous because they know that, there's a lot of guys that do this all the time, and they do it to know exactly where the pain points are and how to utilize the legal system, and not in a moral or good way, but they're working the system, I would say, and no judgment on anybody, but they're just more apt to do that. And so in residential, you're tending to deal with a homeowner who this is hopefully the first and only time that they have to go through this. And, you guys can work something out a little bit more simply without having to have so much strategy in mind before you ever talk to them, and a lot of things in place. Legal is much more expensive in commercial. You have to review a lot more documents in general, depending on the asset. You're also bound by the existing leases and agreements. If the lender did an SNDA, which is a really big thing in commercial. So an SNDA is an agreement between the lender and a major tenant within a commercial building that says, in the event that there's a foreclosure, we're going to honor your lease or your agreements. And if they have that, normally when you foreclose, you can wipe all leases and you get a fresh start. If you're having a subordination and agreement between the parties, there's nothing you can do. You're stuck with that document and stuck with that property. Some people miss that, and they think they're going to do all these things, and they realize the property's kind of stuck for 10 years, and you have to go through a whole nother court to deal with the tenant issue.
And in some instances, it could be vice versa, where a default could also give the tenant an out potentially from their lease for an early termination as well. So that's something else to keep in mind, because you may think, hey, I'm picking this up, there is an anchor tenant in this location, and all of a sudden, it might be, say it's a CVS and there's no drive-through, and they really want a drive-through, and they're looking to strike a deal 2 blocks down the street or something. If that happens and they get their out, then you got to be very careful banking on your numbers. And the other thing I think that hits home too, that people should realize, is you're dealing with an entity versus a homeowner. Like you mentioned, they're going to have much deeper pockets. They're going to be much more sophisticated, and they're going to have a lineup of attorneys most likely compared to what you deal with a homeowner. So you really, I think, got to be a lot savvier and make sure from the team you put together, you really put together an A squad team that knows what they're doing, especially on the commercial side of types of defaults. Would you agree, Carson?
I would, yeah. I mean, I found that there's a great opportunity in notes that's not available in development. And that is, developers are always shaving every dime and I know a guy that can do it for that. Banks don't have any emotion to the real estate. So if you put in your legal team is going to be whatever, make up a number depending on the deal, $10,000 to $250,000, or you have all of these assumptions that are market normal and make sense for the issue, or you point out that the person could go into bankruptcy because that's probable, and here's all the stuff that means with that. If you can articulate all of that, you can actually write down the acquisition price for that and share the information with the lender, and they'll, in a non-emotional way, go, yeah, that's probably what it would cost us if they did that. And it supports you in getting a better basis on your acquisition. So even having that team, it's great to both make sure that you've underwritten it appropriately so that you have the cash to deal with it, but also to utilize that team to make sure that you're providing a great proposal to be able to purchase the asset and be realistic. But our job as note buyers, in theory, I can't speak for you, one of my jobs is to look at all the things that might happen and then utilize all of our skills to try and eliminate them. But I won't know that until after I bought it. So I have to take a pretty conservative approach on the acquisition And then a way to improve the deal is to fix things that otherwise were probably going to happen. So how do we build that relationship? That is one. I would just say, if somebody was going to make a transition between a housing buyer, a residential note buyer, and a commercial.
Yeah, it was one of the questions I was going to ask.
Yeah, I mean, a great place to start, in my opinion, for what it's worth, is something that's very similar. And what's very similar is a smaller owner user size deal, or a smaller deal where the borrower is walking, and it's very clear that they're walking. So that's great. I'm assuming that it's the exact same thing, but for the most part, you're purchasing a note from one of several reasons. It's a performing note, and it provides you a yield. And if you are able to get something at a lower cost to your payoff, then it just improves your yield. You're going to do that to try and, or you're going to do a modification of some kind because the current note isn't actually feasible. You're going to go with the intent of getting a payoff. Maybe there's a balloon payment there and you're negotiating it down, and your business plan is waiting for time, and then you get this payoff. Or lastly, there's a lot of options, but lastly, it's someone who's willing to own the real estate or wants to own that real estate. And the mechanisms that you use to evaluate whether it's a good decision or not really has to do with what you want. So if you want to buy the building, a great thing to know is that the loan amount is greater than the current market value and replacement value of that real estate. So if the note is $2 million and you got an appraisal that says the building's only really worth 1.8, and you have all this other stuff, you're not going to underwrite to the UPB anymore, the unpaid principal balance. You start with that collateral, and then you get to reverse that back. But when you come into play, what you can do to be a godsend to the borrower is agree in exchange for their friendly foreclosure or their deed in lieu to forgive the difference, and everyone can walk away, which a large commercial bank may not do. So there's a great advantage to those smaller deals, and I think there's going to be a lot more of them. So those are regional banks and community banks, and you're going to be looking for attorneys that serve them, and special asset officers or people that deal with that in the banks. Some of the smaller banks don't even have that. I actually think that community banks are probably going to be hit the hardest because they stretch the most. And there is a lot of those. So, you can develop a relationship with one or several of those in your local area, maybe where you know the real estate and you know the people, and maybe there's an opportunity to have a note to review. And
so do you all play in the performing space at all, or strictly non-performing?
Not really. There's different buckets. So the buckets are, in my world, you have regular bank direct deals. You have your auction deals, which are the bank loans that go through DebtX or 10X or one of those things that ends in X. And or you have the hard money guys. Now that's a deal that you can buy for yield. So the hard money guys, coupons are already written to 9 to 14%, and they have all this stuff. And they're the first ones out usually. So there is an opportunity to purchase a note for yield. They're usually a hard money lender's UPB is different than a bank's UPB. So, and I mean that in the way that each of those groups thinks about it. So a bank's UPB, even if it's got accrued interest of $100,000, it's going to be what the UPB was. That's how it's on the books. But for a hard money or private lender, their UPB generally means total payoff with all of this stuff in there.
Yep.
So the difficult part about those guys is you might get more yield, but you're not sure that you're ever going to get all of this stuff above UPB. And the bid-ask spread, which is how much people are willing to pay for what they're willing to sell it for, has been really, really large for the last year. It's starting to get close. And I would say by first quarter, it will be aligned, at least for certain deals. And so I think the transactions will start coming out. Lenders have been writing down quarter over quarter, and I really think that they're starting to release assets probably early next year through the first half of the year.
Yeah, I feel like we've seen pretty much the same thing on the residential side. Just there was 2 or 3 months where it was almost a standstill, just no agreement between pricing expectations between the buyers and sellers. It seems like it's picked up a little bit course, Chris was out there buying all kinds of non-performers anyway, but I do think it's going to open up on the residential side as well. But yeah, so curious, you mentioned a few states you stay out of. Are there a few states that you are targeting in particular, or not so much?
Well, it changes a lot. The West Coast is easier for us, but we have some challenges there. But Arizona is great. So here's what you track, and it changes. So it's hard to answer because it changed for me. I track what is, depending on the situation, how is the legal system there, and how confident are we on the track to get to fee. So if you can really establish that, even with, okay, if they go bankrupt because the situation at least has the probability for that, and that basically would mean that there is subjectively equity available in the building, then there's at least an option to go bankrupt. If not, they go BK, and then they're just going to give you a relief from stay anyway, but it still might add a month or two or whatever it is. But for places where you go BK and that court might be 2 months, blah, blah, blah. So knowing the legal timeline is really important. Environmental liabilities, really important. In California and a lot of states, if you end up with something and it happens to have dirty dirt, you are fully responsible for that, period. And they're going to come after you, and they're going to come after your investment, and that's not great. But you go to Arizona, Arizona has a not your fault, not your issue way about them. So depending on what you're buying, that's really important. And where are the people now? Are they leaving? Are they coming? What type of businesses is there? How are they going to get through this recovery? So, I live in the strangest state that I can think of. California is just wobbling all over the place between all the laws that were just written and what's going on here and there, and pricing expectations. And we have a very unique taxing system, which is, constantly trying to be modified, which makes investment a little bit scarier. And I think the last thing I'll mention, because we could go on for this one, what's the income tax? So I don't know how your investors do things. We set up SPEs, or special purpose entities, for each acquisition that we do. And, we try and have offices in the states that we're doing a lot of business, because there's no need for people that aren't here. If we ran everything through California and our partners in Florida and the deals in Florida and our office in Florida is handling it, well, California's got a 13% income tax. I think it's 12.3% up to a certain height, and then it goes up to 13.3. But that's huge compared to zero. So, if you have $100,000 in profit and you got to lose 12, 13% of it for no reason, then that kind of stinks. So, just look at those different qualities. But the court is the number one. Everything else I can account for, but the timing of what it's going to take to get there, anything else I think you can analyze, and it's somewhat within your control.
You mentioned, talk about timing, speed, control. Just curious, and you mentioned hard money, 914 on a typical deal. Is there a certain type of yield that you look for on these type of deals that when you pencil them out, and from a returns perspective, I know like on my non-performance, I target a certain percentage yield as kind of what I'll bid it to based on worst case exit strategy. I was curious how the commercial space numbers kind of jive with the residential side. Again, with a much larger number you're working with, I'm guessing the overall yield was probably definitely lower than, dealing with a $50,000 note versus a $5 million note. But I was just curious kind of what you typically target or ballpark range.
So how can I answer this question? So it really has to do with which capital bucket it's being grabbed from.
Okay.
So if you're grabbing it from a capital bucket where, the thing about notes is they're all cash transactions, you're not financing them normally unless you're in a totally different league. So, you're looking at that and you say, okay, what does the partners need? And depending on the risk of that deal, let's say your cost of capital is 10%. That's what they need as a preferred return. So if we want the company to work, like we're not going to be able to look at a deal where, you can't absorb the expenses, it can't have the fee, and then, the partner's working in it. I try and get, the market goes from 80-20 splits, cash to sponsor, all the way to 50-50 is kind of where it lands after you have a ton of experience. And the way that we manipulate that is we change the prep. Okay. So, the higher the risk, the higher the risk. I would say if you can get a 20% annualized return, That's pretty good. Now that's not the way it used to be. Some can be in the hundreds and some can be take forever and not go anywhere.
Yep.
But on average, if you can achieve 20%, that usually allows you to cover the cost of your capital and still have enough money meaningful that goes back to the sponsor and sponsorship group. That's a non-performing deal.
Yep.
On the hard money, semi-performing type deals, you can do a lower one. But in my experience, where I've made a lot of mistakes, for sure. One of the main mistakes that I've made is not taking into account the expertise that it really takes to manage each particular deal and the attention that each one of those deserves. And so when we started doing 40 and I have certain people running things, it just, there's a wobble there, and that wobble leads to much lower returns, or they forgot that there was defaulted taxes that were ticking up 18%, by the local state or something. And so that closing comes, your margins are really slimmed down. So if stuff goes wrong, my partners still make their pref. That's really important to protect capital. I really want things to go smoothly so that the company also does well and we do well. Yeah, I'd say 20% is a minimum threshold for a smaller to mid-sized deal. And when you get to really large deals, it can be less, but then we're looking out forward. So if there's a short-term hurdle of, say, a 10% cash on cash while we're holding through an issue, 3 or 4 years later, we might sink an extra X million dollars into the thing to rehab it because the lease is almost up and we're taking more of a development mindset. So when we do that, we can take a shorter return on the front, knowing that our business plan is down the road.
Oh, that answered the question perfectly. I was from that perspective. One thing I want to mention, because you talked about, just mentioned that I see this mistake happen a lot with the residential side. You mentioned the fund and basically the blind pools or the blind funds, which are basically what a lot of note investors will do. And I think a lot of mistakes they do is they offer, again, they'll go out and buy a pool of non-performing without mixing any performing loans in there. And then basically get the clawbacks because, they take time to buy it, then, board it, and then they're all non-performing. No money coming in the door. And all of a sudden they've got this pref that's due that just keeps accruing. And I've seen it with several investors in our space that do that. And all of a sudden they're not making any money for the first 2 years of the fund because they're finally, paying back the clawbacks and stuff. So I'm glad you kind of mentioned that when you brought that up about the velocity, because I think that's a important strategy. And the other one that I thought was interesting was you mentioned the type of use, because like in California, if it's a gas station or a true dry cleaning facility that they do it on site, your risk level in your due diligence, has gone up, significantly. And I'm curious, do you have to do phase 1 or phase 2 environmentals as part of due diligence on any of these, if it does have some type of use that may have higher ramifications on it?
Well, in California, you have to do them no matter what.
Okay.
Because if you do things appropriately, you do your phase 1s, you do your initial studies, you're not held as responsible, especially as a lender. So we do them on absolutely everything.
Okay.
The 2 main reports are going to be your phase 1 and phase 2, whatever that is, and your PCR, your property condition report.
Yep.
Those give you the basics, and even though we don't need them all the time, they're really helpful. But as industrial's gotten more popular, for example, it's not just gas stations and dry cleaners anymore. First of all, the regulatory standards have gotten to the point where if you do have some issue, it is physically impossible to clean the dirt in California. The regular dirt, if you go outside into a park that's never been used, it fails. And so there's no way to get out of your cleanup right now. People smarter than me in the space are, yelling at the senators and doing the things that they do and working with the agencies. But for the last few years, you have not been able to clean up a site, especially about vapor intrusion and things related to dry cleaners. But as industrials become more prominent, what happens is you're going to have a phase 1 done, and it's going to tell you that blah, blah microchips or blah, blah's, aerospace company, whatever, something has been there in the last 100 years that none of these rules applied for. So then that phase 1 is going to tell you that your recognized environmental condition on the property is a historical use. You recommend more testing. And then if you were to do a phase 2, they're going to tell you where it was. And then they're going to tell you that you have to do, hundreds of thousands of dollars in drilling or testing or so. So there is a way of kind of just having the information that you need for your understanding and use, and then knowing the risk, because the way that the system is set up, it's not that easy to get a clean report in certain asset classes today. But for the most part, if they've been used and utilized, in California at least, we have something called GeoTracker, and it will tell you if any state agency has any reporting on this particular site or if you're in trouble. So you can do EnviroStore and that one to really get a feel for, are the regulators going to be involved, or is this just something you're doing for paperwork?
So for our listeners, a lot of them might be on the residential side of things. I just want to explain, a phase 1 and phase 2 are environmental studies that you do on the property to see if there's contaminants or what the soils characterize, characterizations. And if there's, we use the term dirty dirt, which is it's got things in there that shouldn't be, or it's above reportable limits. You may have to remediate or clean those out. And I've done work I'm originally from commercial world, up in Boston and DC, which you've got the other thing that throws the curveball in you which is archaeology, because a lot of these sites might be historic. And I was working on a site in downtown Alexandria that they were pulling a boat out of, that was a few hundred years old because of where the shoreline moved out of the ground and stuff. So it's actually pretty cool, but the amount of money on a development that you can lose because archaeology steps in with literally with the little brushes and, finding things up, it can be, and there's actually insurance for that, believe it or not. But just for our listeners, kind of phase 1 and phase 2, it's another kind of thing as part of commercial that you really got to focus on is what was the use and was there any type of contamination on that property over, like I said, the span of time. So it might not be the store there might now have only been there 20 years, but you have to kind of backtrack to make sure what was there prior to that as well.
And I would think if you're a residential person, if you're next to an industrial site or next to a retail site that maybe used to have a dry cleaner, you have a feeling for it. Yeah. That spreads in a plume underneath. So it could drastically change the value of your home. I mean, you might have a lawsuit on your hands, but you're going to be spending years dealing with that. So when evaluating even a house, I would just take a look at what used to be there. Now you can go back and Google Earth till like 19 whatever, and really see what used to be places. It's nothing that you really need to worry about overly, but it doesn't hurt to put that on your sniff test. Did anything used to be around here that could cause me a big issue?
I'm laughing.
Carson,
go ahead.
Go ahead, Chris.
I was going to say, I'm laughing because when the house I live in now, we built it. And when we were getting under agreement, we knew we were going to knock the existing house down and build it. And as part of the inspection, the lender required a home inspection. But I said, okay, we're going to get a boring rig in here because we want to do test borings because of, we got a lot of soft clays in this area and stuff. I want to make sure that, it could support foundations and stuff for the house because we also have high water tables. So the seller was like, what are you talking about? And so forth. Like when I was explaining to them, I want to get a boring rig and started taking borings and stuff. And just reminded me of, popped in my head about when you were talking about the plumes and stuff like that on property. But yeah, a lot of residential people sometimes, a lot of stuff is new to them. So you really got to explain it. Sorry, Jamie, go ahead.
No, that's all right. I was just curious if you have a kind of a favorite deal that you wouldn't mind talking about, whether that's from, with Phoenix or before that.
A favorite deal.
Put you on the spot.
Or worst deal. Or
a terrible deal if you want to talk
terrible
about
deal.
that.
I mean, those are the ones that people like to hear because they're
the ones you
feel
learn
better
from.
that they're not the only ones.
Yeah.
True.
Well, I can give you 30 seconds on the Brooklyn deal that I talked about earlier, since I'd mentioned it.
Sure.
That was a note that was done appropriately, but it was during the high times of everyone's pressing out loans, and this particular borrower has chosen to literally come up with anything they can. So one of the first lawsuits that took a couple of years to deal with was they had said that the party at the title company had forged the initial of the manager, and that wasn't his signature and stamp. So, I mean, the amount of things that they could make up. Now, this is 11 years of legal. And as a commercial property owner, you have to put the receiver in place. You have to have a trustee when you get to that stage. But you have to pay the receiver every month, which is not cheap to manage things by the court ruling. And you have to cover the insurance, and I'm supposed to be fixing it up, and I got to pay the taxes. So for 11 years, There's no legal recourse for this deal.
It's incredible.
And I've never seen, I mean, that is by far the longest one I've ever heard. And the tricks, and I mean, they've gone BK now twice. They never changed the BK plan from the first one that got shut out. The courts still have not dismissed it with prejudice, so they could even do it one more time. And so there's a certain, be very aware of your borrower, their personality and their traits as best you're able to. Look at their history if you can. I think that's really important. On a really good deal, you know, sometimes we're able to save some companies, and I really, really like that. There was a deal not too long ago in California where a long-term family company, 100+ years, had some financial challenges associated with their contracts with the government and whatever they were doing. And the lenders were coming down on them, and it got really, really bad. And we looked at them, we really liked them. And, you know, we had purchased their note for, you know, not a great price, but we understood the building and what it could be. And you have a choice to try and go down one road or the other. And I met with these people, and they were great. And it's like, hey, we have this giant contract and they're not paying us, and here's what's going on. And we facilitated a side loan for them, saved the company, saved 64 local jobs there. Everyone got to stay. It got down to 2 days and payroll couldn't be met.
Wow.
So we floated until the government came in. You know, we built a great relationship with them. California then, you know, continued to put more regulations on. So they then moved to North Dakota, I think. Anyway, we ended up taking over the building at that point, worked something out with them and purchased it. And we repurposed the building. But they called me a year later, and the government had been delayed. It's really hard if you're in the Department of Defense world to get a building cleared. You have to build everything and have it there before they'll even get an inspector, and it can take a long time. So they had a very similar situation again, and I had no relation whatsoever to this new thing. But we met up and we found a solution for them, and they're just great people. And I got to know them and their family well. And there's just certain things about this job where there's an intimate space created between a lender and borrower, let's say. But you have an option to create an intimate space.
Yeah, that's pretty neat. I mean, that's really why, Chris, correct me if I'm wrong, but that's kind of why you called it the Good Deeds Note Investing Podcast, right? Is to try to come up with these win-win scenarios. It's not always possible. I mean, there's you can't control everything, but that definitely is a feel-good story. That's pretty neat.
Yeah, I mean, it's, you know, probably similar in commercial. If the person wants to play ball, you know, we try and play ball with them and work with them. And, you know, we're not, you know, heartless individuals. We have a responsibility, of course, fiduciary responsibility to our investors. But in the same token, in many instances, keeping somebody in a deal a lot of times is also sometimes the most lucrative. You know, on a non-performing asset, to get it reperforming, you know, get it, you know, brought back to where it needs to be, and then turn around flipping it later on down the lines. You know, it's typically a win-win for every party involved.
Yeah,
sounds like it is on the commercial side as well.
Yeah, I just actually pulled up a flyer from one of our last funds, and the big thing on the bottom of it was profitable investments that make a positive difference. Because in that quarter, we had turned a burnt down apartment in Northern California where there was nothing to do, and worked with insurance, and we got that thing all fixed up. We took an old plating facility that was unusable and turned, you know, we just have these great stories of turning stuff around. And, you know, it's possible to do anywhere, but in notes, there's not other parties involved. You know, it's two individuals or groups trying to work something out. And yes, there's a legal process, but there's a real opportunity to build relationships. And a lot of my borrowers or tenants that were in the buildings, I mean, I had one from 6 years ago called me yesterday and told me everything's actually gone great. Their business plan just succeeded this year and they've crushed it. And he's so excited and curious what I'm up to and if there's something we could work on together, because the relationship is so deep when you're in the trenches like that. And it's just good to remember, you know, I've been on both sides of the fence throughout my life. I didn't grow up with money, and things were tough a lot when I was young. And like, I remember them shutting the water. I mean, I remember all these things, and I try and bring that into my business and, you know, take the human approach and buy things that allow me to do good deeds when they're available. And that being said, I will say this is one of the key rules. As nice as you want to be, which I've learned over time isn't always great, take your legal actions immediately, and then be nice after it's set up. So you're not waiting the 90 days or 100, you know, That was a lesson that took me a long time to learn early on. And it worked out, sometimes, but when the times that it didn't, man, do I regret just not making that small investment and taking those steps because I wanted to be nice. It's like, I can be nice after it's set up.
I think you could probably apply that to your newfound role as a father as well. But no, I definitely agree with that. I was curious real quick. Do you ever play in the second space? I mean, I know that second lien commercial notes exist, obviously, or is it strictly firsts?
I'll basically buy any part of the stack. I'm generally in first, but the second has a lot of strategic advantages at times and generally has a good coupon. So, depends who the lender is on the first. Like if it's Chase Bank, they're not going to do it. They just want their mortgage paid off. So, I can work with them. I can call them and say I'm foreclosing on my second, and it's subject to their mortgage, but that's fine. That's a great mortgage. I probably saved me a lot of time to go get. Yep. So those ones are okay. I don't play in them a ton, only because the amount of equity in those deals tends to be really, really tight, and you never know what the first is going to do. And a lot of the times you're not dealing with Chase or somebody like that because they don't allow the second. So I've had multiple circumstances this year as things have kind of changed in the market where the deals are available as the second and first because they never told their lender they got the second. And so there's a lot of seconds going on right now that were never notified. And now people started paying attention as the market tightened up, and they are not happy. And to be fair, some of those borrowers, they don't read that stuff.
Mm-hmm.
I mean, commercial documents are crazy long, and they're like, well, I got plenty of equity. Why couldn't I get a second? It's like, well, it's just not really how it works.
Yeah.
And to look at Chris's face, he knows that's not how it works.
It's funny. I work for a commercial developer and, been through many deals. And I mean, there's things where, especially now where, they're monitoring, your debt service. I mean, they're just, looking at if you're going below a certain debt service, they're like, hey, you got to pitch in, you got to put more in the reserves. Or, there is, the whole putting a second on, I'm laughing because I've seen that and people do that before and then they get caught and it's like, oh, I didn't know. And it's like, like you said, the documents are, extremely thick, and it's not like 30 days to get these types of loans. There's a lot of underwriting and due diligence that's involved. If you've ever seen a loan application for a commercial, it's it's an interesting feat to complete one, and it's just a completely different type of application compared to
here's the initial application without the documents of one done last week. This is just the app process.
Yeah.
Wow.
So it's real fun. But who's great if you ever have a chance to step up? Life insurance companies.
Yep.
They're really great to work with. I've had a great experience with them.
Can you be more specific, or how do you work with them?
In terms of actually getting financing, life insurance companies,
gotcha.
if you can get to that level, are great to work with. They have no post-closing covenant precedent a lot of the times. And in relation to a lot of banks that just absolutely track everything, it's a lot of work. Mm-hmm. In a really simple form, and I don't mean this to be true everywhere, but in a really simple form, if you make your payments and you still remain financially healthy, they let you manage your property and do your thing. Like, you don't need to go back and ask them a bunch of, they're like, okay, it still has its equity. It's still good. Oh, you lost your big tenant. Okay. You're going to keep paying us. Great. Okay. So it minimizes a lot of the strain associated with the loan, the larger bank deals.
Interesting.
And, for me, that works really, really well. There's a guy named Antonio Hatcham at George Smith Partners. He's the best in the business. So if you ever have a chance to get a large commercial loan and you want to, the stuff they can do is unreal. And I've been really blessed to have them on our team over the years. So life insurance is a good deal. Excuse me.
Interesting.
Sorry about that. My son had come join us and had a emergency. He needed the passcode to log into on his computer.
That sounds right. That sounds right.
So part of the COVID life,
Yeah, absolutely.
juggling many different things. So I guess if you were to give, and kind of you've given a lot of great information and feedback already as we wrap up this episode, kind of you talked about relationships, community banks, kind of starting small. You know, I'm guessing similar to a typical deal, due diligence, of course, is probably one of the number one priorities. A question wanted to ask though was the closing period on, typically if we're buying, call it a single, I know you're buying 30, 40 at a time or whatnot, but, what is the transaction time to close a deal? Is it similar to the space where on the residential where you put in an indicative bid, get it accepted, do the due diligence over a course of maybe 3-4 weeks and then close on the deal? How does that process just work on the commercial side, out of curiosity?
Yeah, I can tell you my experience. I know depending on what
Sure.
tranche you play in, they all work a little
Mhm.
different. Um, I'll just say it's unlike anything I've seen in regular real estate. So the way that our relationships are working these days is the relationship is direct with the person at the bank. Like that's the way we prefer it. You can do all the auctions and they have all those timelines that you discussed, but a direct deal
Yeah.
with a lender is a lot of the work that we're doing is going, it goes kind of like this. Hey, we got something, it's interesting, great. Send me over what you have, and they'll have a few documents. They look at it, do
Mhm.
interested or not interested in, push that back. If we are interested, we're going to have a list of questions and we'll have a list of documents we're asking them to get. They'll send them to us again. We're really trying to work through the process of finding a number and creating a range, because the underwriting for commercial can get quite expensive and intense. So
Mhm.
we do a dance back and forth to see if we're going to be in the range or the ballpark to get all those third-party reports and get the details and the things we want for a real offer. Because of the amount of transactions we've likely done before, we actually do the process backwards from development. We get to a place where we go, all right, let's agree that this is an unknown and this is probably an expense. It's going to be, it's $1 million. That's what we
Mhm.
can do for it. And they're going to take that in. They're going to kind of get that pre-approved by the board if we both find it reasonable, or committee or whatever their process is. They'll come back and go, hey, I think they'll do that. Well, my email saying $1 million, that's the deal. After
Mhm.
that's done, they'll kick that to legal and they'll do their LPSA, which is the loan purchase and sale agreement.
Yep.
And that's going to be on a form that comes in and has a lot of stuff in it you don't like. In general, you can't change any of it. So it's one of the risks of doing that deal. And then that closing time window is fast. But on average, back in the day, like this whole process would have to be in like 10, 15 days because we're dealing with emergency situations.
Yep.
You do have several weeks or a month in that initial process, but that email saying we could do $1 million, that's really the handshake in commercial loans. As the way we've done it is,
Okay.
if we write it in an email that we'll do something,
Mhm.
the legal stuff is just going to come later and the clock starts ticking and we're moving forward.
Okay.
Interesting.
Jamie, any other questions?
Um,
We could go on for hours. I know I
Yeah.
could, but
I think I'm good. This has been really good, Carson. I appreciate your time.
No, you're welcome. I'll be I have a couple like things to look for if you're going to start out. Real couple bullet points.
Oh yeah,
Yeah,
no,
yeah,
absolutely, yeah.
please.
And if you have any
Um,
collateral or any anything like any marking material or anything, feel free to send along. We'll put it in the show notes so people can download that as well, or more information about you. Also, we'll ask later, but if people want to invest in your funds and stuff, how to get in touch with you, we'll hit all that as well. So
Great, thanks. So just the number one thing that I look, kind of my personal approach is I look for the issue, right? In the issue, you'll find out what type of opportunity it is. So if you get the point where you have that lead, start where you're actually a borrower, or you have a checking account. Go talk to your lady, that's, or your man, or your contact, better way to say it. See who's in the bank that does that, and walk down the street and do it again. I mean, that's an interesting way to start. But when they have a note, like identify that issue and genuinely see if it's something you know how to fix. If you're an investor and you also happen to be a contractor, your brother is, and the issue is it's beat up or something happened, then okay, like you can probably figure that out. If the issue is something really complicated and strange or environment, maybe not a good spot to start. The number one things in the business are the basis, the location, and the time. So the basis meaning Have you done a really great job underwriting the risk associated with this deal? If you have, great. You should be able to get a really good basis where you've looked at all the scenarios. The location is going to be your absorption, like how fast could it move? If it's a house, for example, in a great neighborhood, you know you can sell it. Commercial building in Alabama might be a great price, but they only, the average marketing timeline to put that on the market is 18 months, and there's only like 2 buyers within 100 miles. So not really a great place to make sure that your money can actually move for you. And then time, and we discussed this a lot with the legal underwriting and understanding they went bankrupt, what happened. Really do a good back and forth on worst case scenarios with an attorney. You can put all that into your synopsis and try and get a good deal. Your time to fee is the number one question you should be able to answer. Like, what's my time to fee? Well, if everything goes wrong, it's 18 months and 180 grand. If it goes right, it's going to be 4 months and 20 grand. Like, okay, those scenarios. That makes me feel comfortable as an investor. Costs, expenses, and carry. So you want to pencil in all of your costs, including the carry cost of whatever capital you're grabbing, so you can see how it actually works for you. I made that mistake early and I always forgot about myself. So, when I'm looking at someone to start out really thinking about loading in the cost of the capital that you're planning to use, and the return on the deal is a return for you. You can always do a deal level return, but it's a good way to evaluate the situation of what happens if time happens, because you're the one doing the work there. So I think I lost my train of thought there. Anyway, another one is just have 3 exit scenarios. So when I look at any deal, first thing I look at is, if I got it to fee tomorrow and I had to fire sale it, what could I get for it for sure? And then what is the net result of money in my pocket from that? So taking away commissions and fees and blah, blah, and staging costs, whatever it is. What is that number? How does that return go versus these other 2 exit scenarios I'll have later if they paid off or if this other thing happened? But if you find a scenario in which you can lose money, I would invite you not to do that deal, or just offer a price in which you wouldn't lose money, because you don't want to start off losing. That's really the number 1 rule, if there was a number 1 rule. And we discussed it earlier, but even though you're probably a nice person, take the legal actions necessary and spend the money to get everything in place. Even if someone's working with you and they sound great, let them know you'll be happy to work with them. Inform them that you have to make these legal notices and do these other things as part of your role, but you're still there to talk to them and work on them. That will get you in the front of the line if things go wrong, or, God forbid, the borrower has an issue and someone else takes over, or whatever happens. It really protects you and really protects your investors. So I could go on always for a ton, but in today's environment, I'd be looking for things that and you understand, that both have an upside potential and they have cash flow. A big empty building right now in commercial that you're not sure what to do with is not going to be something you're going to want to hold, because that will drain your dollars quick. If it can at least carry itself while you figure it out, that's going to be a better deal to start with. Just a couple points.
2 things that kind of pop in my head as you mentioned that. One's a question, one's kind of, well, actually both really questions. I see sometimes people in the residential space, I'll use the term, I'm kind of an honest, I see it, they go cheap. They'll either use like a cheap attorney, they try and sell the house themselves. I mean, in the commercial world, I would think you really can't do that. If it's a little retail center, you kind of would want to get a retail broker that specializes in that, not trying to stick a little for sale sign in front of it. You want to get a top-notch attorney from that perspective. Would you agree with that? Typically?
Well, I think it depends who you are, but yeah, in general, I'd say unless you have, that your 10,000 hours of experience in that bucket, you're great. The good thing is, brokers are free. They have a lot of information. And by free, I mean they get paid when there's a transaction. Their consulting doesn't cost you anything. They likely have good referrals for attorneys and everything else. Managing your attorney and not allowing your attorney to manage you is key. So what I try and write out is my best thinking, my objectives, and the things that I really need to know, and tighten in their frame, because your budget will go from 50 grand to 5 if you've already put in the thinking and you have very specific questions and you provide them the information they need. Attorneys are whatever, some X dollars an hour, between 1 and 1,200, depending on what you need. And if you can take all that time off their plate, you're going to save yourself a fortune. When I got started, I would get it to the point where I could be on the phone. I would watch the 15-minute mark because that's how they charge no matter what.
Yeah.
Right.
And I would be like, if we had 29 minutes, I had one more thing. I'd be like, all right, I gotta go. I'm not paying an extra $200 for one question.
So have you hit 1,200? The highest I've hit is 700 an hour is the highest I've hit on, and that was a land use attorney. So I'm curious, in California, you probably do have $1,200 an hour attorneys, but
Oh yeah. And you can tell how much someone charges by how fast they talk.
yes, they talk very slow, and they also
Hello, Mr. Faris. I'm like, shit, you're at least $1,000.
And the other thing is not only them, but they have an associate that also is always on the call, and they bring like a little group. It's like they bring like they're like Smurfs, it's like Papa Smurf and all the little Smurfs come. So all of a sudden you'll have like 7 of them on a call, only 2 of them talk, and then you get your bill and you're like, oh my God.
I think it's really, this is legal if you're going to get into commercial and maybe residential. I can't speak to that, but it is the number one cost saving skill to develop. And I would recommend 2 things. One, get very, very clear on what you want to know, what your questions are, open-ended or not, and make sure that they've had time to look at that quickly, because that might be free and then your evaluation is going to be less. But 2, don't forget who the client is. A lot of people are scared of their own attorneys and they don't lead them and direct that. Like they're scared of them because they're an expert in the law. Well, you're an expert in your business. And what you need to do is negotiate like you would do with anything else. If they're telling you that to foreclose on your whatever should be X dollars, see if they'll do a bulk fee. If something doesn't make sense to you or like didn't make you any money and they took forever doing something, the number of times back in the day when I got started that there would just be a runoff lawyer, and I would just pick up the phone like, what are you guys doing? They're like, yeah, we probably did stretch on that. And Angela had to learn that first and you shouldn't pay for that. Those phone calls would be like a $2,000 difference by just asking some common sense questions. So don't forget who works for who, respect them and need them. But, you start to carry an animosity towards an attorney who's actually supposed to be there to support you when you allow them to just do whatever they want and you're not clear about what serves you.
That's
and
really
appreciate it too.
That's a really good point. I know Chris has recently mentioned on our podcast that there's nothing wrong with getting a second or even a third opinion from different attorneys. We say that in the medical field, but people don't seem to think that, and they think an attorney knows everything. Well, they're just people that are well informed on a certain topic. So yeah, those are all really good points.
Now that's probably
If you're going to get 2 or 3, then I recommend that you form your potential clienthood in the form of a question and say, I have a building that is blank, blank, blank on blank, blank. My goal is to know blank. How would you get me there? How fast and how much would it cost me? And you get to watch their thinking, because the styles and strategies of each attorney might be very, very different. Mm-hmm. And if nothing else, now you have 3 different versions of what's possible. You can still choose yours, but you can take some of the better ideas from the other 2 and integrate that in. And maybe the other attorney is better for you on the next deal. But I found that to be really, really helpful. And as long as you're kind of meaningful and using them and their services over time, it's a great way to find what's best for you.
One last question I had is on the commercial side, if there are tenants and stuff, do you have somebody talk to the tenants to try and get a feel for what's going on in whether it's, office or retail? Are you allowed to talk to tenants and stuff just
Not usually. The commercial world, you can't speak to the borrower. This is until you close.
Yep. Okay.
And you can't have any communication with the tenants in a formal capacity as a potential note buyer. If there's a Dairy Queen there, you can go get yourself a Blizzard and you can talk to the staff and you can look around and see if it's busy. But banks are very, very sensitive, especially on the commercial side, of what they're doing. A lot of the times they're not notifying anyone they're selling. It's something that they need to do for themselves, and they don't want the borrower to have a bad reaction to it or not understand that the bank's trying to sell it to someone who's going to help them instead of some chop shop or whatever. So
it's similar residential, like when someone asks, hey, give me the borrower's phone number, I want to call them and ask them while they're not paying. I'm like, okay, cross you off the list from selling you an asset. You can't do that.
No.
So as we wrap up, Carson, how can people learn more about your funds, more about what you invest in? What's the best way for people to learn more?
Well, at this time, feel free as an individual just to learning what we're up to, we're www.phoenixif, like investmentfund.com. It'll tell you a little bit. That's a bank-facing website, so it's kind of more for our lender clients. On the investment side, we've kind of closed everything down for the moment. Not looking to do anything. We're doing more one-off transactions, and we're not raising any funds at the moment. But in the event that anyone ever needed anything or had a question, they could reach me at carson@phoenixif.com, and someone will get back to them and answer a question either on investment, or if they had a question with the deal, we'll be happy to do that.
And all this will be in the show notes, so people can go to show notes and find this information as well. So, Jamie, any final thoughts on?
Thanks a lot, Carson. It's been really informative, and I'm sure our audience will really appreciate it and get a lot of value from it. So thanks.
Hope so.
Yeah.
Have a good one, guys. I appreciate it. It's really been a pleasure to be on with you.
Yep. Thanks, Carson. And thank you everyone for listening.